Joe Kalish joins us, Chief Global Macro Strategist at Ned Davis Research. Joe, good to have you with us. Let's begin with the yen on the move higher following the news from the BOJ and the expected hike.
Yeah, I think, Ben, we were looking for a hike. It's a little bit more aggressive than I think we in the markets were expecting. And I think this was just something they needed to get done and get going. I mean, we looked at something like the real rate that was in Japan, and they're clearly going the opposite direction from the rest of the world. And their policy rate was fairly accommodative. You were looking at a real policy rate of around minus 2.6%. And that's just way too low. And so they needed to get going here. They did that small step in March. And it looks like they're going to do another rate hike maybe before the end of this year. So certainly on the path to normalization, along with, I think it was more along the lines of expectations that they were going to cut back on their buying of JGBs and go from about 6 trillion to about 3 trillion. So that was pretty much in line. But yeah, looking for moving along this path of normalization.
Yeah, I like the idea of time to get going, right? We're going to talk about that in a minute, how it's not just the BOJ, but kind of sticking with that idea. Was it more aggressive in your opinion because we got 15 basis points versus 10, or was it the idea that Governor Ueda suggesting that there could be more hikes this year?
I think it was both. The market was kind of leaning a little bit more that it could do up to 15 maybe by September, but it wasn't quite as priced for this week. So it certainly gives them the scope to do more and certainly surprise the market. But yeah, I think the combination of both is really adding to support from the yen, which really had gotten extremely oversold. It was way too cheap. This is another thing we had pointed out, that the currency was way too cheap. And, I'm not sure, maybe in the back of their mind, with some of the comments that former President Trump had made about the yen being too low, maybe that was figuring in their mind, let's get that off the table. So we're not a political target.
I mean, Joe, this is one of those situations I was jokingly saying in an environment like this. I mean, whether you're talking about intervention multiple times, right, or some of the other factors you just mentioned, blindfold me, hand me a dart, spin me around 10 times, I'm going to throw it and hit something bullish to the yen, right? And even kind of, again, furthering that point, just one more idea I just wanted to get a thought on. Very aggressive in many ways when you consider that they basically have their bond buying purchase program as well.
Yeah, look, I think, again, it gets back to intervention is not going to work if you're just doing it by yourself. It's unilateral intervention. We've learned that. And the only real way to combat that is to make changes in policy, which is what they did. Yeah. And then if you add on top of that, what's likely to be Fed policy going forward of easing, the two together really give a policy mix to help strengthen the yen and moving a little bit more back toward what would be a fair value and not so undervalued as it is today. Okay,
so time to get going in terms of the BOJ, and they're starting it, right? They're becoming a bit more restrictive, and the yen, a reflection thereof. Talk to us about, is it time for the Fed to cut, or should they wait till September?
Well, they'll probably wait till September, but yeah, they need to get going too. And thanks for referencing my latest piece about this time to get going. But the Fed really hasn't given us any indication that they want to go this week today, right? So they're probably just going to wait and tee it up for September. So I'm really looking for 3 changes to the statement. They talked in the first paragraph about modest further progress. I think they'll just drop the modest and just say, there has been further progress toward the committee's goal. The second thing is that they've been talking about in the second paragraph that they've moved toward better balance. I think they're going to say the risks are balanced, and so that'll give us an indication. And in the third paragraph, they talk about the committee does not expect it to be appropriate to reduce the target rate until it has gained greater confidence. I think maybe they'll changed the language to say that they're gaining greater confidence. And so that'll give us if we have one or all of those types of changes, I think that'll flag to the market that they're ready to go in September. Of course, Powell will say at the press conference that they're data dependent. Every meeting's a live meeting. And so he'll still be conditional on further data confirmation. But I think he'll give this expectation that, again, just as we talked about with the Bank of Japan, the U.S. has the opposite situation. Their real rates are around 2 3/4, which is way too high if an economy is really in better balance. We don't need that degree of restrictiveness.
Joe, also in your report, Time to Get Going, you talk about the data dependence, right? And you reference it in terms of it being a problem with not having operational framework, being data dependent, is that you risk falling behind events. You say the Fed's evaluating data that's lagged and the impact of its policy response is also lagged, or what you call lag squared. Can you explain that a little bit?
Yeah, look, I mean, if you don't have a general theory or framework about how monetary policy should work, and you just say we're data dependent and you're going to be watching the incoming data, all the data that we look at lags actual activity.
Yeah, you're behind the curve.
And so you're behind. If there is a sudden deterioration, if you're waiting for that data, then you're not going to have the appropriate policy setting if things go south or things go the way you don't expect. And that's a risk. That's this risk management portion of the Fed policy. So your actions alone also take time, right? So there's a lag in that implementation. By the time the markets kind of adjust or the real economy really adjusts to the new policy settings, there's a lag there. So that's why I called it lag squared, is that there's a lag on a lag. And that's why they need to move their policy settings and their policy rates down to be more reflective of where they think the balance of risks are.
Yeah, I like that, the lag in terms of the indication and also the lag in terms of the implementation of their policy. That's a very good point. Talk to us about where does this all put the BOE ultimately as the dust settles from the Bank of Japan this morning, the Fed this afternoon, and then as we await the Bank of England on Thursday?
Yeah, I think the Bank of England will also have cover now to cut rates, particularly if the Fed gives that strong indication. Maybe the BOE will wait another meeting, but given where the strength of the pound has been, and given the fact that we've gone through the election and the new Labour government doesn't seem to want to upset the economy and the markets, I think there's scope for the Bank of England to ease policy as well.
Talk to us a little bit about some of the, considering the circumstances as we head into the second half of the year, your equity allocations here. Where are you positioned? Where are you finding opportunity here now?
Yeah, so we still like equities. We're still overweight equities. And we've moved a little bit more toward a balance between the small cap and large cap and growth and value. There certainly are reasons on the back of easier Fed policy to understand why you might want to move out of some of those large cap growth tech names and have a little bit more balance. But that essentially assumes that we have this Goldilocks outcome for the economy. But if the economy comes in weaker than people are looking for, then that trade might be fairly short-lived. But for now, it certainly looks like it's happening, and it makes a little bit more sense to have a little bit more exposure to the broader market.
And Joe, internationally overweight emerging markets, it looks like?
That's the house view. There's part of that is the fact that interest rates are coming down or expected to come down in the U.S. The dollar should weaken, and that should help out some of these emerging markets. Again, the U.S., there's nothing wrong with the U.S., and the U.S. market still continues to perform well.
Yeah, I think that's what a lot of people were scratching their heads about when we saw that selling the last couple of weeks, testing those or nearing those June lows ultimately. It didn't really seem like it was based on anything, any real legitimate concern. Just a bit of a shift in terms of sentiment. Joe, appreciate you joining us, sharing your thoughts here with us this Wednesday and helping us get ahead of the Fed, the Bank of England, and summing up the BOJ for us. Joe Kalish, Chief Global Macro Strategist at Ned Davis Research.